Well, good morning, everybody. Welcome to today's Monday morning mortgage update. My name is Sean Wohland, and we're going to jump right into this. Hope you guys had a wonderful weekend. And if there's any questions you have, you can jump into the chat or you can just raise your hand. I do have the ability for you guys to just speak up if you want. You are most likely on mute, but you can unmute yourselves if you desire. So we're going to jump right in and I'm going to share my screen. There's been some updates to Zoom, so I'm going to make sure I'm sharing it properly here because there's some additional options you can do that I'm trying to just, there we go. All right, perfect. It didn't mess me up. So today we are not in a good place. Um, we are down 22 basis points today. So what's happening in the markets? Well, we have a lot more escalation happening in Iran. And unfortunately, this is the type of war that there's oil involved, natural resources involved. And if this causes additional issues with delivery of oil, that could be inflationary. Mortgage rates do not like inflation. Inflation is the enemy of mortgage rates. So when we see escalation like this, it's not a good thing for mortgage rates, which means it's not a great thing for the overall real estate community. So let's just see where we're at because this last several weeks has been a little rough. Um, if you can look back here, June 30th, we were at the best spot for rates. That's where I locked in a majority of the loans that were available to lock at that point that were in process. Then we lost quite a bit over this last 2 weeks. So July 15th, we at the or 13th was at the worst spots. And then we started to get a little bit better on some better news of what was happening in Iran. And then we're losing a little ground now. So there's a lot more to go downward on this candlestick chart. If you look at where we're headed, we're going downwards when the Fannie Mae 30-year mortgage-backed security candles start losing ground like this. We're most likely going to end up on this next Fibonacci level. That is 99.64 to 90. It's another 16 basis points. So that's not a good thing. It's not terrible. I mean, we saw rates in the eights back a couple of years ago. It's not going to go there. But as we see rates continue to increase, that makes our buyers a little skittish and they want to wait. I want to discuss what it looks like, the buy now and refi later type of mentality. But it does help to present that to our customers. But at the same time, they do have a pretty strong psychological barrier because we've been spoiled is the best word for it for the last several years. Between in like 2018 to 2022, rates were in the fours and down to the twos. So rates in the six, it does have a mental block on a lot of people, but this is where we're at today. If you can look at the 10-year, we're up 6 basis points. We're above this Fibonacci level. If you can see right here, we are just above that. And we are now going probably all the way to the top, like we did we kind of retreated back last week. So we're going to need some really good news out of Iran to come back below this Fibonacci level, which is the 4.59 level. But right now we're above it, and that's not a good sign because it's easier to go to the next level of resistance. It's pretty simple, especially when you see the Fannie Mae have so much room here to fall. So not the greatest overall picture for mortgage rates this week as far as what the trends are with Iran. There are some talks of some more blockades in the Strait of Hormuz, and I mean, there's Saudi Arabia involved now. There's a lot. It's kind of a mess. So we definitely need that to open up, and we need Iran to get back on track. It's interesting what's happening in that country right now, but it doesn't have a great impact on mortgage rates, that's for sure. So let's see where mortgage rates are today. These are the average rates right now across the industry. 30-year fixed, we're in the mid, the 6.67 range. Keep in mind, this is if you have a really good credit score, 780 or higher, 25% or more down, and you're in a single family detached primary residence, all the bells and whistles, this is the perfect rate. 15-year, you're in the low sixes, 6.17. That's still pretty good. 30-year jumbo, we're in the high sixes. You can get an adjustable rate mortgage in the low sixes, 6.37. The FHA and VA are right around the 6.28, 6.30. Mortgage rates on VA and FHA are usually better, but there are added fees to FHA and VA. Like the FHA has the MIP, the mortgage insurance premium of 1.75% of the loan amount that's rolled into as a fee. And VA does have a VA funding fee unless you're eligible veteran with disability, and that's waived. So this is where rates are right now. And overall, it's not the best, the prettiest picture. I'm going to share my screen or come back to here in a little bit. It's not the prettiest picture for rates, but they're still relatively steady. They're bouncing in the low to mid sixes or low to high sixes over the last year or so. We really want this to dip down into the fives. We all believe that when we do that, when that actually happens, buyers' psychology will change and they'll start coming to the table again. Some of them understand, but I want you to know it's very simple right now to get sellers to give concessions to get lower rates. So we have to be out there aggressively stating that if I can get you a mortgage rate in the fives, would you be able, or would you want to purchase a home and either vacate your home that you currently have that has a rate in the three or fours? Because that's a big problem. A lot of our customers have rates twos, threes, and they don't see the motivation to move into a bigger home right now because it's so inexpensive for the mortgage they're in. So we have to create some sort of a bridge to the psychological bridge to the next move, especially if they're looking to grow their family, if they're having expecting kids, whatever it may be. It's still very, very difficult to jump to a rate in the sixes. Rates in the fives, maybe in the fours, could be potential with buy downs and with creative options. And that's where I differ. That's where, as a loan officer, I present things a little different. So I'm going to show you the software that I use real fast. You may have already seen this. If not, I'm going to give you a bird's eye view of what I do with my customers to show them exactly what's happening with mortgage options. And what they can do. So this is what I call a mortgage total cost analysis. I can show 4 different scenarios side by side as to what that looks like for overall payment, and I can get really, really creative. Now, this is interactive. So when I am on my computer and I highlight this and make changes, it'll automatically change on the customer's computer as well. And we can have a dialogue and change this live together to really explore how different options with rate, with buying out MI, how that has an impact on the overall payment. So if you can look at this scenario, I'll be quick with it. This first one is a 30-year fixed, normal 30-year fixed with no points. Right now, 6.625, it tells you what the payment would be, $5,848. Well, I can break this down by clicking on the more info and then having a total payment breakdown with the principal and interest, the taxes, the homeowner's insurance, and it breaks down the payments. But for now, we're just going to look at the summary to show you what I can do side by side, and then we'll go into the details. But you can look at the one next to it, which is a 30-year fixed with no mortgage insurance. So this eliminates the monthly mortgage insurance. The rate's the same. The fees are a little higher, about $6,000 higher, maybe $5,000, $4,000 or $5,000 in there, and we'll show this in a second. But this has no mortgage insurance. That saves you $117 a month. The next one we're going to look at is a 30-year with a 1-year buy down, what that looks like. So instead of 6.625, the buy downs are a little bit higher in rate. So we're at a 5.875 the first year. What does that save you per month? $406. And then what if we combine the 1-year buy down with the no mortgage insurance option? Now you're saving $523 a month that first year. So this program that I have, we can make changes live. And as we make changes live, like on this first one, I'm going to show you what this looks like. What if the borrower wanted to do, instead of 10% down, they wanted to do 20% down? I can make this change live, and you'll see the down payment option go way up. You'll see the mortgage insurance on that go away. And then you'll see what the new payment is overall, and that will change. And now this is the cheapest one, and this compared to the most expensive saves $487. So this is what I call the total cost analysis approach to what your options look like on a mortgage. This is very important because in the mortgage industry, I'm going to stop my share real fast. In the mortgage industry, it's not always about rate. It's about strategy. And the problem with the problem with the mortgage industry is that when people say, what's your rate? Lenders can quote anything. I can say, my rate today is 4.99. And you're like, wow, that's great. All right, I'm going to use you. You have the best rate. And then they don't tell you that, oh, yes, that's with a 1 year buy down plus a permanent rate buy down, which is going to cost you, $26,000 in extra fees. But we can try to have the sellers pay for it. That's not the game. The game is these are all of the options. This is how it looks. This is what we need to do to present to the seller an offer that will get you the rate you need. It's not a smoke and mirrors, bait and switch type world. We have to be very clear with our buyers as to what the options are and how to get the lowest rate possible and what the negotiations need to be to get there. So when we look at these total cost analysis programs, and we look at different purchase prices, we can look at different properties side by side, and we can do that live with your customers before they make the offer. So that's a critical piece to really understanding what your payments are going to be, what the cash to close is going to be, what rate options are available to them, and how to really get into a home at the payment they need before they make an offer. Because there's nothing more scary for a borrower than making an offer, not knowing what the actual payment's going to be. They're just trying to get the cheapest price, but not always the cheapest price equals the cheapest payment. A $10,000 reduction in sales price is a higher payment than a $10,000 credit towards buying the rate down. So we need to really look at all these side by side, and this software program allows us to do that. So it's kind of fun. I enjoy it. I love educating. I don't know if you guys knew this, but I was a teacher the first 2 years of my life outside of college. And my mother was a teacher. I love teaching. I love education. I think education is the key to make a really smart choice when choosing a lender. And yes, rate is very important. I will never be beat on rate. Make sure you understand that I will never be beat on rate. If there's somebody that's advertising with an actual quote, a lower rate than what I am for that day, I will match that. So I just want to make sure you knew that. So if you have somebody saying, I got the greatest rate possible on some online obscure lender, let them know that I will match it and I will keep their loan local. I will keep them with a licensed loan officer in the area that knows what they're doing, that has a lot of experience and is in the top 1% in the country. That is important to get to the finish line because let's just face it, in this market, there's so many different things that we have to look out for as a lender. There's these buy now, pay later loans that don't show on credit that can be a menace to a mortgage platform. You can actually finance your groceries at at the checkout screen. You can finance your groceries for 3 to 6 months. That doesn't show on a credit report. But once we get into the loan cycle and we start running through these really technical reports, they do pop up then. And so we have to ask really pertinent questions. These online applications where the questions just aren't asked on these things can really make it just destroy your actual process and your loan altogether and make your customer get declined the last week of the mortgage. That's happening all over the place right now because of these buy now, pay laters or IRS payment plans that don't show up on credit. So getting a local lender that understands all of these before it can help prepare to create a really, really solid process is critical. And understanding the numbers through my total cost analysis is just one of the ways that we can do that. So thank you guys for hanging in there this morning. I wish I had better news for you. Just hope that this Iran conflict, this thing goes away. We can have the Strait of Hormuz completely open and we can get back on track with lower rates. Because right before this happened, rates were in the fives, guys. They were in the fives. We were on our way. I was excited. Customers were excited. Buyers were excited. And then boom, the Iran war hit. And then it was very short-lived. So hopefully we will be able to get the rates into the fives after this ends. And we will be on our way towards lower rates. But until then, we're probably going to have this fluctuation into the lower and higher sixes. Let's hope that oil prices stay low. The volume of oil coming out of the Strait of Hormuz is not what they want right now. It is lower. So gas prices are increasing right now, which again is not good for mortgage rates because it's not good for inflation. So if you have anything, any customers, I'm here to help anytime I can. I have no vacations planned for the rest of the summer, so I am here to serve and I'm here to help. So let me know how I can be of service to you. Have a wonderful day, and we'll talk to you soon.